I think in this type of environment, certainly post-election, it's very difficult to find uncorrelated returns because you have large macro factors that are driving markets. So tariffs, for example, that you just mentioned, or other potential changes that a new President Trump administration may put in place, whether it's taxes or regulatory changes. All of those are driving markets in a way that makes it more difficult for individual idiosyncratic company differences to drive those returns. Obviously, as you extend over time, then some of those company-specific drivers should come to the fore, and so it would be a bit easier to find alpha. Though I would say it's never easy. It's never easy.
Okay, these big macro themes, right, which is making it harder to find alpha. I know that your strategy, or it could be just tactical, I don't know, you tell me, is simply, look, just to get out of the way, go defensive.
No, it is. I mean, I think it's really both. So for our portfolio, we would have a barbell approach. So we wouldn't go completely defensive. I mean, we do have cyclicals in the portfolio, for example, U.S. home builders, right, that would benefit from not only tax decreases for U.S. corporates, but also continued reduction in U.S. interest rates. But at the same time, when we look at the valuation of U.S. markets, they are at the high end of their historical range. Right? No argument there. It doesn't mean that they'll come down next quarter or the quarter after that. But in our mind, it does mean that you'll likely have a better opportunity to buy some of the expensive companies at better prices in the future. Where we do see opportunities are in some of the defensives, for example, in utilities. I like to call them defensive growth because
hold on, let me jump in here quickly. Sure. I mean, utilities. I mean, they've ramped, right? As the Trump coming back fear crept in, right? Yes. Aren't they looking expensive?
Well, I think it depends on which utilities you look at. They're more expensive relative to where they were before, but I don't think they're really pricing in not only the growth, but really the certainty of the growth that you'll have going forward because they're still less expensive than the market. So, in particular, I mean, at a high level, you haven't had electricity volumes growing in the U.S. since the financial crisis, basically. But now you have proper volume growth, really as a function, not only as the electrification of vehicles, but electrification of all things, including data centers and AI, obviously consuming a significant amount of electricity. So you have growth kind of coming back. At the same time, regulated utilities need to invest a significant amount of capital into the grid for transmission and distribution, all of which they earn a return on. So if you look at some, for example, Edison Electric, which is the Southern California regulated electric utility, it trades at still a 25% discount to the S&P.
Is that right? Wow.
But is giving you 5 to 7% earnings growth, close to a 4% dividend yield. So in our mind, you actually can earn low double-digit total return, which is fairly certain, given how the business is set up, at a multiple that's 25% less expensive. So it's defensive, but I actually don't think you need to give up a massive amount of growth.
Yeah, okay.
Brian,
4% dividend yield either.
What do you make of how this market is valued? This is a historically expensive S&P. It just feels like it's even more perfectly priced. Is a correction coming? What is the catalyst for that correction? How deep could it be? And would that be a healthy opportunity that you would take advantage of?
Yeah, it's a great question. I mean, we have felt markets have been expensive for quite a while, right? And have certainly been on the back foot, I think, in our positioning, or haven't been as aggressive as, in hindsight, right, we should have been. I think you have to look at it two ways. If you look at, I mean, GDP is still growing in the U.S., obviously at a quite healthy clip. Corporate earnings are still growing. Inflation is coming down and interest rates are coming down. Those factors together actually don't happen that often, right, all at the same time. That is quite constructive for equities, which is obviously what we're seeing, and the reason that they continue to kind of make higher highs. We do think that a correction would be healthy, but you will need some type of catalyst for that correction to take place. I think it could be one of two things. I mean, we are seeing economic growth in the U.S. slow, still quite healthy, but it is slowing, right? That can be a catalyst if that continues to slow a bit more. If we were to see inflation tick up again, right, that could be a catalyst as well. And then I think finally, if we look at corporate earnings expectations for next year, even if you exclude IT and communication services where growth is exceptionally high, excluding those, earnings growth is expected to be 10 to 12%, right, which is relatively high compared to history. So I think if you have high expectations coupled with high valuations, then if you do see that earnings growth start to slow or expectations start to roll off, that could be a catalyst for a correction as well.
Yeah, Houston, we've got a problem. So tell me, Brian, Europe, utilities there, how are they looking, and are you finding any value?
Yeah, so we are. So, I mean, I think it's interesting in that utilities are very jurisdiction specific because they are quite regulated, whether it's by state or country or even city in the case of some. In Europe in particular, we are invested in SSE, Scottish and Southern, which is obviously UK domiciled, for many of the same reasons that we are invested in Edison Electric. I mean, the UK also has a plan, for, as many jurisdictions do, a plan to reduce climate emissions, but also more significantly to increase renewable generation and to put investment, the required investment, in place in the transmission and distribution grid, which SSE will be a significant beneficiary of. And from a valuation standpoint, it's actually less expensive, I mean, as UK equities are in general.
What's it trading at?
It trades at about 10.5 times earnings. Oh. It's a similar, slightly higher dividend yield to Edison. Earnings growth expectations are more modest. They're not yet in that 5 to 7% range. But my expectation would be that over time, right, as we move forward, analysts will begin to increase their earnings growth expectations as they see, right, the investments that need to come to be sure that the UK can also reach its climate goals.
Brian, where